Again, my name is Ralph Redlin. I'm a CPA and a CVA, Certified Valuation Analyst. I'm a manager with Sitzberger Widman & Company CPAs, and I've been practicing in accounting since 1972. Eventually, I hope to get good at it. The focus of my practice to a great extent has been on the construction industry, ranging from, gee, I think I'd like to be a builder, startups, all the way up to $300 to $400 million a year construction companies that do large commercial construction and everything in between. Primary focus being residential builders and developers. It's Mark Widman.
I'm Mark Widman, and I have over 25 years of experience in accounting. During that time, I've had the pleasure of working with a number of home builders. As a firm, it's an industry that we have a special interest in. We have 4 or 5 CPAs in our firm that have quite a bit of experience working with home builders, small commercial contractors, and related industries or subcontractors. And Ralph and I, in particular, have been very involved in the MBA, and we're looking to develop new relationships with business owners. And hopefully, during the course of our session today, you will share some of your ideas with us. We're going to be giving you some tools, for some food for thought, but these are our ideas, and we're certainly interested in your ideas and maybe some of the things that, the planning ideas that you've gone over with your people, with your professional advisors.
We hope to give you some tools. We're not really experts. You guys are the experts. I once heard the definition of an expert. An X is a has-been, a spurt is a leak under pressure. We aren't experts in any way, shape, or form, but we are working hard to develop tools to allow the construction industry, as well as other businesses, succeed at whatever it is they're trying to do. There's a few things that you got that were given to you on the way in. Some articles, and for posterity and those who are looking at this DVD 7 or 8 months from now, we are in the middle of what some people call a recession. A recession is when your neighbor loses his job. Some of us think we're in the middle of a depression. A depression is when you lose yours. Bottom line is we're hoping to see some recoveries in 2009. One of the agreed upon first signs that recovery is starting to happen is when the construction industry starts to return. So we'll be having our pulse on that. The good news is Milwaukee is reported as the only major U.S. metro area with rising home prices. There's an interesting article there. There's another article that I gave you, which is part of, again, a bank's effort at keeping us informed about how to survive, called Finding the Upside in a Downside Economy. A lot of it's common sense, but I've put it to work in our place in the last few weeks, and I think it has some benefits. Now, we're in changing times. There's no doubt about that. Things have been changing forever. Back in 1961, a cup of coffee cost 10 cents. Today at Starbucks, it can run up to $4. Pretty ridiculous, in my opinion. A new Chevy used to cost $2,500. Now it costs $25,000. The price of gasoline, we've done this particular seminar twice, and the last time we did it, gasoline was $4.09 a gallon. Today, as we speak, it's, I think, about $1.95 a gallon, but back in 1961, it was 22 cents a gallon. What's it going to be and how's it going to impact us? We don't know. Bottom line is, financing the construction business has got some parameters and challenges. You need to have some tools, and we will guide you in the development of concepts on how to develop the tools, and then move from there into, all right, where do you go to get it? Now that we've got the tools to go to get it. So the first part of our talk today is going to be by Mark. Mark's going to help you develop some tools that are actually critical to doing the managing of the business, banking, financing, leasing, or for that matter, even your own self-satisfaction about how am I doing anyway. Mark?
All right. Before I get started, Ralph and I, we have the pleasure of having our names up there on the board and being in front of all of you, but we have to give some special thanks to people back in the office that put all of us together for us. So there's Chris Gilbert and Annette Brookins and Ellen Warnkin. And certainly without their help, none of this would happen because Ralph and I are quite inept at putting together PowerPoints. All right, as we get started here, some of our goals for today are we want to define how much money do you need in order to run your business. And for some of you, you may have to put together models in order to determine how much financing you would need in order to put together some capital equipment purchases, whether it's cranes or any kind of heavy equipment that you may need. This is a very basic concept, but everybody in business is always concerned about their gross profit. And when you're putting together your model, you want to shoot for a certain gross profit percentage. And generally speaking, when you're developing your gross profit percentage, you'll start out with your estimated costs for a job, and then you want to mark that up in order to obtain your gross profit percentage. And there's a common misconception that if you would want to get a 15% gross profit on a job, that you'd take your cost and add 15% of that onto there. Well, that's not how you'd want to do your calculation. In order to get a 15% gross profit, you take your cost and then you divide it by a factor, which is equal to 100% minus your projected gross profit that you want to get. So as an example, if you have total costs on a job of $200,000 and you want to get a 15% gross profit on it, well, then you determine your contract price by taking $200,000, dividing it by a factor of 100% minus 15%, which gives you 85%. And then that will result in a sales price or a contract price of $235,295. And then by doing that, then you'll get your gross profit of 15%.
Okay, so what's the point? The point here, because it would seem like many of you probably already know all that. The point is comparability from a performance measurement standpoint. In terms of generally accepted accounting principles and in terms of banking and getting financing and measuring how are you doing compared to other people in your business, those who are outside, and for that matter even industry surveys, use gross profit as the measure really to determine how are you doing in your business, how well do you know what you're doing compared to others who are in it. That's where comparability starts. There are, and you'll see a little later, Robert Morris Associates statistics that banks rely heavily on, leasing companies rely heavily on, and others. Certainly expense structures, those things that you spend money on a discretionary basis, are unique to your company. And that's part of your philosophy of doing business and so forth. But at the gross profit level, at that level, you should be comparable or better, hopefully better, than the average. And that's why we go to great pains when you're financing your business to get you to focus, to get a construction company, manufacturing company, retailer, or anybody else, on the gross profit, because that's where you're going to be measured against other people in your business by those who really care, including yourself. All right.
I skipped ahead one screen, but I always find it helpful that, in particular with our home builders and remodelers, that throughout the year that you put together a schedule of the projects that you've completed. Oftentimes it can be very informative and it can tell you things about your business that you may not have been aware of. And because it can give you an idea as to which types of jobs are the most profitable for you. Or it could be that if you have a larger organization with a sales staff, you may be able to identify which of your salespeople are higher performers than the others, not only in the number of homes or projects that they sell, but also that they are achieving a higher sales price on their homes that they sell. Because as a part of this whole project, what you want to do is be able to increase your sales prices. All the heavy lifting is in the sales area. You can always work at controlling your costs, but the thing of it is that you can whittle your costs down to nothing. But if you've done that and you're not producing anything, well then where are you at? So all the heavy lifting is done with your, in your sales force. Another point that I wanted to illustrate here is that oftentimes a business owner will think that by getting more sales that they're automatically more profitable. And that absolutely is not the case. So in this illustration, we've got 6 projects that were completed, and when we're all done, we've got $179,000 in gross profit. Well, then you decide that you're going to take on a real big project, which based upon the other contract prices is a little bit out of that this company's comfort zone. And it turns out that they lose money, $34,000 on this project. Well, in order to get yourself back up to 179, which is where you were at, you have to build 2 more homes within your normal comfort zone. So the point is if you want to expand your business, oftentimes you have to stretch yourself a bit in order to get into new projects that that you've never done before. But you don't want to overreach on it and step into a situation where you're losing money, because you have to build 3 homes then just to get yourself back up to a level where you were at if you had just stuck with what you do best. In my second scenario here, it's the same homes were built except you skipped the loser. And your total sales here are almost $600,000 less, but your gross profit is much higher. So this is what you want to achieve. It's not working more, it's working smarter. In putting together a forecast for the year, oftentimes you have to put yourself into a situation where you're breaking your product down into easily obtainable goals. So you may want to set up a scenario where you think that you're going to develop your sales for the entire year, and then you budget all the different costs that you have throughout the year. And this would generally be your starting point for budgeting for this year, the forthcoming year. But as you get started in this process, what you have to do is break your homes down. Your projected sales for the year.
When you're flipping like this.
That's the only time I'm going to flip ahead. Okay? So what I've done here is I prepare a schedule which shows your projected homes that you want to build throughout the year. Now, generally, in my planning, I assume that the month that the home is started, it's only a half a month of production. And then I spread the gross profit out over the estimated time that it's going to take you to build a home. Now, in this particular case, we'll assume that the builder is going to get an average gross profit of 11% on all their homes, and that it takes them approximately 6 months to complete a home. So by spreading your sales out for the year in this manner, you can determine that your estimated gross profit for a quarter is $192,000 for this quarter, $193,000 for that quarter. So then you can flop those numbers into a business forecast for the year. So in this case, we've got it broken down by quarter. Your direct costs are your materials and subcontractors. And then in your other cost of goods sold, you may have indirect payroll, which would be your expediters, the person that helps you make your color selections. They meet with the customers on different planning. You may have a design person in there. So those are the things that would go under indirect costs for your cost of goods sold. And then we've got payroll taxes, depreciation for your construction equipment, and other related indirect expenses that have to do with the construction of a home. Then we get into the general and administrative. And you know, the first item here is the salary or compensation for the owner. And this is in the planning. In your planning sequence, you start out with, this is what I think that I can obtain. So based upon how the market's going, how many homes I've got contracted, what I think I can do going down into the future, then you start factoring in all the expenses that you think that you would need in order to complete those homes.
Mark, this exercise quite possibly is something that many of you do or have done or have seen done. And there's a number of reasons why we do this. Why do we go through developing these tools? The whole point, really, as far as financing the business is concerned, is to answer the question by either the investor or the lender, how do you know? How do you know? When you're going to start a business, it's often the case that you sit down, usually to justify it to your wife, with a pencil and paper and work on the overhead budget or your plan, what you know your costs are going to be, what you feel confident you can accomplish in terms of build and completions for a selected period of time, and you get some comfort in the knowledge that you know where you're going. I think Yogi Berra was the guy who said it. If you don't know where you're going, you're going to end up someplace else. Bottom line here is bankers lend money not based on collateral. Collateral is why they can or can't make loans, but it's not why they will or won't. They will or won't based on your apparent ability to repay. The apparent ability to repay is how have you done in the past, how credible have you been at the gross profit level, controlling expenses and all that, and what do you expect? Now, in this economy, today, January 2009, some would argue, well, there's no way we can know what's coming. No, but you know you've already made some policy decisions about what your expense structure is going to be and how difficult those are to reverse. You know you've already made some cost decisions, so at the very least you can do some computations at assumed gross profit levels to arrive at what is required break-even analysis. Going through those machinations and getting that documented and actually having it in your portfolio of stuff gives the banker confidence that while there are certain issues that you have no control over, what's the world going to do? What are interest rates going to do? What's the market confidence going to be? At least when it comes to your business, you have your handle on it. So that's why the tools. The tools so that you're disciplined, you're literally disciplined to make policy decisions right at the beginning, even though they're difficult to make, and you've calculated, at the very least, break-even analysis in terms of required volume. Once you get beyond that and things begin to turn, then the notion of flexible budgeting starts to take over. Remember, this isn't a constraint so much as a description. So it isn't chiseled in stone and something you have to report back against continually, but it's something that you can flex as the facts and circumstances change. But the fact that it's written, the fact that it's presentable in some sort of visible fashion, electronically or otherwise, allows the investors, yourself, the managers, the bankers, and everybody to kind of know where we are, where we think we got to go. That's the whole point of developing the tools. So if it seems like, gee whiz, we've been there, done that, seen that already, why should we bother when we really don't know what's going to happen? The answer is because if you don't know what's going to happen with regard to your business, certainly nobody else does. And a banker wants to know that at least you know. That's the point.
Thanks, Ralph. So then in doing we can break the entire year down then into quarters. So by doing this, then throughout the year, you can get an idea as to how you're actually performing against your budget. And it may help you to make adjustments in other costs or do other planning in regards to that. The other thing that you'd want to do is make provisions in your budget for other expenses that you would like to incur. I don't believe that I have anything in here for a retirement plan contribution. For many of you, it's a big thing that in your whole business plan is that you want to provide for your retirement I think most of you also want to provide for your employees' retirement too. Most every business owner that I have worked with, integrity is very big to them. Absolutely, they want to make a profit, but close behind that is they are very concerned about their integrity. They're very concerned about their employees' well-being as well. They want to be regarded as a good employer. It's not just all about the bottom line. So in this case, we'd have financial net income of $99,000 for the year. So assuming that you've got a 6-month build time. So how does this help us translate into cash flows? Well, if we start at the top with net income of $99,000, then we have to add back some of the non-cash expenses that we've had. So we had total depreciation of $38,500. We've had loss on the disposal of an asset, that's really a non-cash item. It didn't cost you anything to get rid of it. It cost you something when you had to purchase it initially. And then there's other adjustments, cash flow adjustments that you will have to make depending upon your balance sheet. Down here in the planning, an item that would be a cash outlay would be the purchase of some equipment. So you want to take that into account. You may have some proceeds from the sale of some old equipment. That gets added back into your cash flows that was determined with your net income. So then as we work down the line here, this helps you determine what kind of financing you will need in order to continue your normal business operations or to purchase some new equipment. So then we drop down and we've got a total increase in cash for the year of $201,000. And then assuming that you've got $56,000 at the beginning of the year, we've got cash at the end of the year of $257,000. So in my next example, this entire production schedule is the same. The gross profit percentage is identical, it's 11%. The only difference here is that instead of having a 6-month build time, now we have an 8-month build time. So down here I've indicated how many homes we'll have under construction at any one time. If you have an 8-month build time and you've got a full slate of homes that have come through the pipeline, you'd have 18 homes under construction in this case. If you look back at the 6-month build time schedule, you'd have 14 homes. So what kind of impact does this have on your business if you have 28% more homes under construction at any one time? Does that mean that you've got 28% more phone calls coming in from your customers asking questions about what's happening with their home? You've got more planning to do with your subcontractors as to which homes they're going to be working on and what's happening there. And you may have to have additional personnel to handle all this, but these are things that you will need to know in order to do appropriate planning for your business.
Well, planning and managing. Either the business does to you what you let it do, or you focus on critical success factors in running your business. If one of the measured critical success factors is compression of the build cycle in order that you realize more efficiency, a little more, instead of 11, maybe 11.5% gross profit, and generate better cash flows, then that's something you need to share with your vendors, your employees, suppliers, and everybody else. That in ABC Builders, I, Mr. A, have the goal to compress the standard accepted, pretty much industry agreed upon build time of 8 months to 6 months and not lose an iota in quality or gain a nickel in cost, in fact maybe to compress cost. So the whole goal here is to take a tool, flex it a little bit, see what happens, and then begin sharing your management decisions as a result of what you see. So if one of your decisions is, we can't live with a 9-month build time, it soaks up too much of our cash. Back in the cash flow statement, you saw accounts receivable. There also would be work in process and accounts payable and so forth. If you take a too long a build time, your receivables, the money you got tied up, and this is all pretty much common sense, but when you put it black and white and look on it, then it becomes a little easier to make the decision. We're not going to have a 9-month build time. We're not going to have an 8-month. We're going to have as a goal 5.5 months or 6 months. We're going to share that with all our suppliers, share that with all our field superintendents. That's going to be our personal goal. Now, when it comes to vendors, the longer the build time, the less likely, given the standard number of draws and things, they are to get paid in time. I once heard a story about an old gentleman that made a lot of money and he sent his kid off to Harvard. And the kid came back with a master's degree and he says, Dad, you know, we got to change how we run this business. We got to have job controls, job costs, computer-oriented construction mechanisms and this and that. And the dad said, thanks, but sit down. I'm going to tell you, you only need 2 things, wisdom and integrity. He said, what? I'm talking controls, I'm talking spreadsheets, you're talking wisdom, integrity. He says, yeah. He says, fine. Then tell me, what's integrity? Integrity is if you promise somebody it's going to be done in 6 months and you're going to get them paid in 30 days, then if you have to work all week, the day before it's due, you get it done. Okay, that's integrity. What's wisdom? Wisdom is you don't ever make those kind of promises. All right. Bottom line is promise to your vendors that they're going to get paid on time. You get efficiency from them. Promise to your customers you're going to compress the construction cycle. Promise to yourself that you're going to take an overt approach to running your business where you put it in spreadsheet form and you demonstrate it to yourself. What do I got to have to break even? What's my overhead decisions that I'm actually overtly making? What kind of tools do I need? And what happens if things flex? Then set your goals accordingly. That's the whole point of this exercise.
So moving ahead to our the yearly budget, you'll see that even though all the operating expenses are identical, we've got general and administrative expenses of $488. Our other cost of goods sold are the same. But when we get down to the bottom line, we've got $77,000 in comparison with an 8-month build time versus a 6-month build time. We had $99,000 in net income. So you need to know this type of thing in order to manage your business. It has a big impact on your overall cash flows, but you'll want to know this as far as how much of a salary can you take out as the business owner. How many people can you add on? So throughout the budgeting process, it's not a matter of that you set this up at the beginning of the year and then you kind of ignore it. That's not the point at all. You do want to take a look at it each quarter and compare it to what your actual operations are and make decisions and adjustments as you go on. You want to see what is happening with your business. I've assumed that we're going to have 2 homes a month, contracted and started. What if things drop off and a couple months you've got 2 homes, but then you've got a couple months where you're only starting 1 home? It can have a dramatic impact on your overall operations. And organizing your business plan in a fashion like this will help you prepare for these ups and downs and changes in your business. So now with our going through the similar change in cash flow calculation, again, most of the facts are the same as the 6-month cash flow, the 6-month build time. However, at the end of the year, we've got $234,000 in cash versus under the 6-month, we had $257,000. So again, these are just things that you want to know. What is the nature of your business? Where can you make improvements? And if you can't make the improvements, then what kind of adjustments do you have to make to your overall operations? Another thing that I have found out with builders is that if they're able to shorten their build time, it's a better indication that they're far more organized in their overall build process. The construction industry is not rocket science. Neither is accounting. Accounting is pretty much its debits and credits. However, construction does require a great amount of organization on your part in order to do it efficiently. And some of the benefits that you have by being more organized is that generally you'll end up with happier customers. Because if you're able to properly schedule your jobs so that you know when the subs are supposed to be coming in for their part of the project, you gain more credence with your subs, first of all, because they know that, geez, if I'm working with this contractor and he says I can start a job on a certain day, they know that they will be able to start that job on that day, and they can plan their crews accordingly. And these things can all flow through in your overall business plan. I have heard from some contractors and from some subs that they get price adjustments if they know that they're working with a contractor that they can count on their construction schedule because
Well,
they have
actually,
to manage their business properly as well.
Yeah. Most of you are familiar with critical path thinking. The notion that from the beginning of a job to the end, there are a variety of steps along the way. It's foregone conclusion that you think that way, but to actually document it and get it into computer form, sounds a little odd, where each one of the component parts of the project are documented with line graphs and so forth, beginning and end dates and so forth, rather than just what we see, unfortunately, all too often, is intuitively. This is done rather than in a disciplined, documented fashion, it's done intuitively. Hey, I've built 100 houses, I know how to do it, and I know how to get it done. Well, that's true, and that's certainly great administrative control. But to get accounting and record-keeping control, to get control in systems, procedures, policies, and practices requires tools, and we really, really recommend that you go to the point of doing that, even for small jobs, even for small remodeling jobs. The point being, that gets efficiency. That gets the job done. That's what really compressed times and profitability is all about. Moderate the critical success factors, schedule the work, make sure it gets done, and reward those who get it done. That's obvious, but it's not often thought of that way. And all of the organizations that I've watched, including one organization that was doing about $100 million a year and had always abided all of this, took on a big project, about a $110, $115 million project out of state, and decided that the construction managers really knew how to run this project, had designed it ahead of time, didn't need to bother with critical path thinking. Result, by the time we got around to developing financial statements, charts were all out of whack, things were all haywire. They ended up losing money, and they're gone. They've been in business, they were in business from 1933, and they're gone. So our point in belaboring this issue is quite simply documented plans, modified for actual performance, critical path management behind the financial plan precipitates profitability. Our goal for all of our clients, and for all of you, I'm sure, is to make more money. Get to be a year from now and not have negative numbers. Make more money. A definition for us of a really good client is somebody who is professionally managed, who does critical path thinking, does forecasting, projection, and policy making, or wants to be. None of us are perfect at it, including our own business. We do it every year and refine constantly. But that's what it's all about. Scheduling, critical path thinking, compressed times, efficiency, and you end up with positive cash flow, and nobody's unhappy when you get positive cash flow. All right, thanks.
But it also provides you the opportunity to have a comfort zone that your business is operating in a fashion that you can accept. So even in a downtime like this, oftentimes our clients are asking us, what's going to happen if we can't achieve these sales levels? Well, then if we're able to put together a plan for them like this, well then at least they know that, okay, we're going to have to adjust these costs, might have to cut my salary down some, and make some other changes to our plans, but at least they know that they're going to be able to weather the storm. And so even though they may be far less profitable than what they had hoped for, they still know that, okay, I can weather this for a year, for 2 years, and we're going to be okay once we get into a normal construction economy. in this example, the only thing that I changed on it, this is back to a 6-month build cycle again. However, all I've done is just increased all the contract prices by 1%, because oftentimes clients they just think that a 1% change in my sales has very little impact to my overall business. And they kind of lose sight of the fact that by making modest improvements in their business can have a very positive impact on them. I guess we had a slide out of place there. So in this case, we'd have sales for the first quarter of, gross profit of $211,000. For the year, we'd have $875,000. We've kept expenses again pretty much the same. However, we've got net income now for the year of $179,000. So compared to the initial example that we had of a 6-month build time, I believe that we had net income of $99,000. So we've added almost $80,000 to the bottom line with just a 1% increase in sales price. So again, if you have a larger organization where you have to work with your sales staff, you constantly have to be working with them to keep your sales numbers up there. If you're doing your own selling, there again, it's giving a 0.5% away here, 0.25% away there, can have a major impact on your bottom line. And in business, you want to keep your customers happy, but you also want to keep your subcontractors happy too, because everybody's got to be working together. You don't want to have unhappy customers, but you don't want to have unhappy subcontractors as well. And even though you would like everybody to be controlling their costs and getting your best price, there's only so much that businesses can do. And if you can't make a profit at your business, well, then you might as well not be in business. And the other thing, if you are working with people that are not making a profit, well, you can't rely upon them as being a subcontractor to you for very long, because they will go out of business themselves. So then you're going to have to look for somebody else. So in all of these examples, what the point is that doing planning, doing forecasting, it's not something that you just do once a year and then you let it lay, because your business is changing throughout the year.
Well, one time we were doing a rather large project for a company who was doing about 40 projects at once, and the project managers would fail to pick up their reports at the end of the month. And so they would have to be called and told, stop by, pick up your reports, and eventually they'd pick them up. And the word around the organization became, well, did you go pick up your My reports? And what do you mean, My reports? And I was told, well, a My report is one where you pick it up and you go, oh, My, and put it down and forget about it. Well, that's not the point. The point here is to develop systems, procedures, practices. We're going to get into where do you go to get the money and how do you get it, but you got to have the tools and the habits where you report against what did you intend, what are the standards in the industry, and how are you actually doing. So Mark said this is something we do. We run it through at the beginning of the year, and then we revisit it at the end of a period, say a month or a quarter, depending on how long you want to go. And you don't just generate My reports, where you compare it to the actual, compare it to last year, and you look at it and go, oh, My. No. Either the behavior was working, in which place some people need feedback. Congratulations, it worked, we're doing well, we're on path, and all that. Folks like to know what's going on. No one likes to get treated like a mushroom. You know how that is? That's where you're kept in the dark and fed bullshit, right? Okay, nobody likes that treatment. Everybody wants to know what's going on. So the subs and everybody want to know that they're dealing with a success-generating organization, and the reports that you actually use allow you to feed that back. And customers like to know the project is right on progress, right on target, and it looks like I'm going to make some money on it. Customer's happy that way because then he knows you're not going to cut corners. So there's all kinds of management techniques and tools that are derivative from these accounting type reports that you can build into the culture of your company and your management style. That's what it's all about, really. Not selling more Dell computers, selling more Timberline or other software, but actually to develop the policies, procedures, practices, and routine habits that get you to make more money. All right.
And in all of my examples, I've broken the forecast down on a quarterly basis because I find with remodelers and home builders that a 3-month period of time is it's a reasonable amount of time for them to have impacted their business significantly without overkilling on the accounting side. But if you're a roofing contractor or a flooring contractor where you're working on a much larger number of projects for a shorter period of time, you may want to break down your budgeting process into a smaller period of time. Maybe it's every other month, maybe it's every month. You certainly want to have your monthly financial statements done. But you want to be able to set your goals for the year, but then you want to be able to break those down into easily obtainable tasks in doing that. And you want to revisit it often enough that you can have an impact on your end results. You don't want to wait around until the end of the year. Some of the things that Ralph has touched on is that oftentimes during the course of the year, I don't know how many of you have to use a bank for your financing. Most all of you have banking relationships. Do your bankers ever ask you do you have a budget? How are you performing in contrast to your plan? Does anybody ever ask for that? Because we have clients that do. If you're out trying to obtain new financing for a project, the banker wants to have some reassurances that you are paying attention to your business, that you're not waiting for an entire year to go by before you start cutting costs or laying off crews, or that you've gone out and bought a new piece of equipment at a time that your business is taking a step back. So now the last slide that I have here is we're just setting up forecasting, and this is more for planning for differences that may come about in your business. So with the first scenario, I just assume that that 13 homes are built with an average sales price of $300,000 with a 12% gross profit percentage. And we work down to a net income based upon that with $28,000. The second one is that we've got all the same facts and circumstances as the first scenario, but you want to give a 5% pay increase to some of your employees. So you want to figure out ahead of time, well, what kind of impact is that going to have on the bottom line? Because you want to pay your employees fairly, but why do you want to take a cut in pay in order to do that? Everybody wants to make more money. So this will help you plan for adjustments that you have to make in your overall game plan in order to achieve the results that you want.
Okay, which gets me to the point of how does all this start? We got all these beautiful slides and all these spreadsheets, and it's all neat, orderly, done and tied out. Where do you begin? How do you begin with all this? Well, you really start with the bottom line. You start with committed, known things you have to do already. We have to make this much money, or the juice isn't worth the squeeze for us to be at it. We have to make this much in debt service. We have to pay these people back, and we have to reserve some funds for the future. We start with the bottom line. Then we start with policy decisions about overhead. The rent is the building. We have a lease that we have to pay for. We have a certain fixed group of employees, bookkeepers, accountants, and other crazy people who we have no matter what. That's that. All right? We work our way backwards, really, to the point where we determine what is requisite in gross profit. And then break it down by logical period, known seasonality, winter, and so forth, and say then we need to get this much gross profit, this figure, fill in the blanks. Month or quarter, starts with year. Fill in the blanks. Which says then this is our sales goal for break even of what we minimally need to do in order to run this business. So it starts backwards, works its way up, and then we loop through it. Then we loop through it a couple times and make some assumptions. But we started off with an assumption here, I think it was about 10% gross profit, went to 11, and massaged it a little bit, and massaged some costs, massaged some overhead, and that's how you end up with the finished document. It begins with, what do we have to make this all worthwhile and pay the people we need to pay, including ourselves? What are our commitments? What do we have to get in gross profit? What percent is reasonable in today's market? What sales do we have to accomplish? What's our goal? And then we report against that after we work through it a little bit. Now, one more point. This isn't something you do, this is probably bad news for many of you. It isn't something we advocate that get done once a year, just before Christmas, because it can be very depressing. We don't want the holidays to be bad, and all that. No. We don't want to do it that way. What we want to do is a 12-month or a 4-quarter budget, and then live one quarter and tack another one on, and refine the ones in between for known facts and circumstances, changed policy decisions. Live one more quarter, add one more on, change the interims for known facts and circumstances, and changed policy decisions. So at all times, we have a 4-quarter, what's called a rolling forecast, cash flow plan and budget. That's the tool. Now, what's a good client? Someone who's professionally managed and wants to be. Not one business that I've seen fail, and in 36 years I've seen more than my share of failures, has ever failed for an excess amount of time and effort spent planning, forecasting, financial thinking, budgets, and controls. Never. I have never seen a failure precipitated by that. I have seen almost every failure precipitated by a lack of foresight. Management was slow to act. They didn't know things were changing as fast as they were. They didn't really have a handle on the bottom line. Oops, they owed a lot of taxes that they didn't anticipate, didn't know were coming, hadn't forecasted. That's what precipitates failure. Not an excess amount of time spent forecasting, budgeting, planning, and financial thinking. It just doesn't happen. So that's what it's all about. Those are the tools. Those are the keys to the bank vault. That's what you need to do. That's what it's all about. All right?
A very common factor or scenario that we have in these economic times is a third one, where suddenly you find out that you cannot, you're not selling the number of homes that you would like to, and or maybe that you're having to drop your prices and so forth. So you want to be able to plan for it, and if you know, I think that you can see this is a pretty simple spreadsheet. It's not really something that you have to have your accountant lay out for you. Quite often with our clients, what we do is we'll put together the initial plan for them, but then we always encourage our clients to be very much involved in the whole plan, to really critique it, so that it's not our thoughts, because as Ralph had mentioned earlier, nobody really knows your business better than what you do. And so all that we do is we hope that this is a tool that clients can use, so that it will help them focus their attentions on their business as to really what is happening. And it's quite easy that you can put together a number of scenarios with something like this that can help you get an idea as to what your results are going to be, what changes that you would have to make in your business. And then lastly, I'm just getting back to the point about what can happen with small increases in prices of your homes, so that even, you know, you're building the same number of homes, but you've had a small price increase. What kind of impact can that have on your bottom line? Raising prices, it's very difficult to do. It requires some great sales talents on your part or on your sales force's parts, but it can have a huge impact on your overall business. So I don't, does anybody have any particular questions on this? We
Yeah,
do
that,
find quite often that the bankers do want to have, they want to know that you are looking forward on your business. So they're reasonable business partners. Just because you show them a quarter where you've lost money, they're not going to pull in your line of credit or anything like that. But what they do want to know is, are you making any plans to change anything? So it's like if you're forecasting a loss of $40,000 for a quarter and you come in with a loss of 80 grand, all they want to know is what's happening. Why did you have a loss like this? Are you doing anything to change things for the future? If your sales drop off even further than what they have been, what can you do in order to ride out the storm? And a tool like this can help you communicate those kind of thoughts with your spouse, with your employees, and with the bankers.
Amen to that. Thanks, Mark.
Sure. Thank you, Ralph.
Mark's comment about sales, you may have heard this before. Selling, if you're going to operate a business with integrity and with wisdom, remember that story, sales is done by an organization like that on a quality basis. What's quality? Quality is like oats, you know, after the horse, they're cheaper. There's always going to be somebody cheaper than you. So the 1% makes all the difference in the world. If we have 1,000 clients in our company, if a normal curve exists, the ones who are on the desirable side of profitability are always doing only 10%, maybe less, of what they do different or better than anybody else who's in that business. It's rarely a whole lot of things done different or better. It's always the little bit. It's like a tractor pull. It's that little bit of extra energy, that little bit of extra work in selling that makes all the difference. In financially orienting your business, that makes all the difference. In creating these reports that become more than my reports that make all the difference. Now, so why do we get in the first place? Well, we like what we do. We're good at what we do. That's understandable and that's satisfying. But the real whole point is to make money. Bottom line, eye on the bunny's tail is we want to get to be a year older and have more money, or have spent it on a wine, woman, and song or something, than we had a year before. That's our whole goal. Let's don't lose sight of that. Well, I had a really enjoyable year, but you lost money. Well, I did a lot of good building and I built a lot of great houses, but you lost money. You know, then it's a hobby. It's not a business. All right? The mission here is to take you, if you are in a hobby, to being into a profitable business. If you're in a profitable business, I guess to reinforce what you probably already knew and then just get you some credits. Now, Clark Howard. Many of you might know Clark Howard. He's a radio personality. I listen to him all the time, and I laugh out loud a lot when I listen to him. But recently he had a radio program that I was going to call in and argue with immensely. And he said, accountants will call in and argue with me immensely. And he said that you can use your retirement plan accounts to invest in your closely held business. There are ways to do it. He didn't explain how to do it. You will need professional help if you want to do it. Yeah, you'll need a lawyer to represent you before the Internal Revenue Service is what you'll need. In terms of investing in your business and starting your business, we, on the outside looking in, understand that that's your baby. That's your stuff. That's your job. That's what you really want to be doing. But the real bottom line is containerizing your life, especially your financial life. The reason you have retirement plan funds is to isolate them from your own short-term behavior, the world's short-term behavior, and mistakes that can be made that you may not be able to recover from even in the long run. The goal of having retirement funds set aside, in spite of what happened in the investment stock market and bond market and everything in the last 16, 18 months, is to isolate investments. So a caveat would be, if you own a business, focus and keep focused on containerizing your investments. That is to say, try to make sure that the business finances itself, or that you've very carefully invested in it what it absolutely needs to survive and prosper, that you're not taking literally the old story, all your eggs and sticking them in one basket. Sounds like common sense, but a lot of folks do it all the time, especially when you have your own business. You tend to pledge through personal guarantees, collateralized and otherwise, all the pieces of real estate that you have, everything you own, maybe mortgage your future and all that kind of stuff, and end up with all your eggs in one basket. So what we try to do as we're developing a business plan is to retain separately some net worth personally. So that's one of those bottom lines as you're beginning the budget process is we want to minimize, even in the worst of times, not unlike the way we did with the Metropolitan Builders Association, any contributions that have to go to operations that come from previously accumulated saved up money. For your edification, I'm on the task force that does finance management for the MBA, and we cycled back through the budget process 4 or 5 times with Shelley to get that down to no more than $50,000 to go into operations this coming fiscal year. Very uncomfortable decision making. But you start by containerizing your investments in your life. That's a foundation decision. That's the caveat. Then, if you're going to use retirement plans, and some people do anyway, keep in mind that if you use money that you've accumulated from IRAs, if you withdraw it prematurely, you're going to have to pay tax and penalties on it. If you take it out of a Roth, you might be able to get your own money back, but that violates the whole process and reasons for having a Roth in the first place. If you collapse retirement plans and get money from there, that's not a good idea because you're violating the containerizing process, putting everything back into business. So we try to avoid that. It's sort of a house of last resort, maybe a last resort before bankruptcy, and quite possibly bankruptcy is even more desirable than that. God forbid you should be thinking about having that option. We don't want to do that. We just don't want to do that. We want to use as much as we possibly can of OPM. Now, I'm not saying that you guys should all go out and get hooked on opium, but I developed that little phrase back in the 1980s, and now I'm hearing politicians and Charlie Sykes use it. Other people's money, OPM, as much as possible within reason of other people's money. There are a variety of places to get other people's money. Certainly, you can get it from personally borrowed mortgages, you can get second mortgages, you can get friends, relatives, and so forth when you're starting up, sometimes even when you're in business already, and that's fine. Other people's money is a good thing. However, documentation. As far as the Internal Revenue Service is concerned, if an enterprise borrows money from somebody other than a bank, that is to say, if you own a closely held company and you're going to borrow money from a friend, a relative, or a silent partner, they generally are a little loose on documentation. IRS says, no, you can't be loose on documentation. If you're loose on documentation, then we're free to determine what it is if you didn't. Here's what I mean. $100,000 is lent to you and you put it in your company. The $100,000 comes from a friend or relative, and he says, well, just give me something when you get it later. You put it in the company and your accountant says, is it a loan? Well, yeah, it's a loan. Do you have a promissory note? Well, no. Does it have a due date? Well, no. Does it have interest? Well, we haven't decided yet. Are there repayment schedules? Well, yeah, we hope to get it back someday. Hey. Well, now, wait a minute. That's not a loan. At best, that's a gift, or maybe a contribution to the capital. And then when you do start taking it out, if it's a contribution to the capital, it'll be called a dividend. It'll get taxed twice, once at the company level and again when you take it out. So, documentation is critical. It's essential that when you start a company and you're going to do it with your own money, that care be taken as to what the character is of what's going in. Now, certainly, in a corporation, for those of you who understand about entities, a corporation sells stock. If you sell stock, you generally can't get the money out until the stock is redeemed in one form of liquidation or another. So that's like the most permanent of all investments. All right, we try to avoid that in closely held enterprises by using lent money, because when the company generates financial profitability, then you can get it back out. So, documentation. We want to make absolutely certain that you've got promissory notes, interest rates, due dates, repayment plans, or for that matter, if there can't be a repayment plan, that the due date is, and now we talk about banking, more than a year if we want long-term debt characterization and less than a year if we don't. Now, one more point. Everybody else will come ahead of you. Everybody else will come ahead of you. The capital stock in a corporation, the members' equity in a limited liability company, the contributions to capital of a partnership or a proprietorship is the last money out. Everybody else comes first, unless you lend the money to the company yourself. If, for example, a friend of yours lends you $100,000, this is fairly common, and says, I want to lend it to you personally, you put it in your company, all right. If he doesn't want documentation, well, that's fine. However, it's better if it's clear that he isn't buying a part of your company. But it's okay if you don't have really great documentation with him or her. But when you put the money in the company, if you don't put it in a stock, if you intend to put it in as a loan, then you want documentation, as we've talked, promissory notes, interest rates, due dates, repayment schedules, and all of that. But the point that's often forgotten is to keep you ahead of everybody else in the event of a crisis. To keep you just one leg up on everybody else, maybe except the bank in a crisis, do a recorded security interest. Do a UCC filing. Go and get registered at the state. It costs about $10. And you can file a security interest which will secure the debt that you've provided to your own company. Well, you mean I'm going to get my money ahead of the accounts payable or ahead of everybody else? Yeah, everybody else except the bank or anybody else who's got a tangible security interest. But by collateralizing your own loans, if you didn't intend them to be capital, if you actually have notes and you got all that stuff laid out correctly, promissory notes, due dates, interest rates, and all that, well then why not collateralize it? If you were lending to the guy across the street $100,000, you'd want a note, a due date, interest rates, a repayment schedule, and you'd want collateral. You'd probably want a mortgage on his house. You'd want a UCC filing on all of the equipment. All right? So keep in mind that in terms of going and getting money, if you're going to deal with OPM, other people's money, and it's going to be somehow lent and not given to the corporation permanently, that you want to have the documentation correct, and keep in mind that a collateralized security interest, a real estate security agreement, or a UCC filing is a good idea, because then in a crisis, you're ahead of everybody else. You're ahead of everybody else.
One thing I wanted to add to that is that it is very critical. Most everybody that starts up their business, they want to have a separate entity to provide them with limited liability. And Ralph has touched on some things here that it is absolutely critical that if you are loaning money to your own business, that you have these loans documented like that, because you may think that you're one and the same, but legally that is not the case. So you want to absolutely have all the loans documented. You want to follow the terms of those loans. If for some reason you feel that your company is not able to pay you the provided interest rate and so on and so forth, well then there's always ways to plan around that. But you want to follow what is going on with the documented loans, because otherwise you can get yourself into a position where your personal funds and your company's funds are treated as one and the same from a legal standpoint.
Yeah, we're not necessarily here to give legal advice, but it is very easy to form entities these days. In the past, you had to hire a lawyer for the most part to form a corporation, and that slowed down the forming of corporations and tended to get them a little more formalized. Today, you can go online this morning and form a limited liability company, Ralph Redlin LLC, and away you go. But if, for example, you had formed one of those, it only has substance in legal reality if your behavior follows the correct patterns. If you behave as if it doesn't exist, commingle personal and corporate activities, commingle personal and corporate tax payments, make loans to the enterprise and don't document them, well then all the liability shelter from having created the limited liability company evaporates. I have attended and taught some classes for lawyers on the use of limited liability companies as for tax purposes, and they are the loosest record-keeping organizations that we see. So if you're going to form a limited liability company, make sure you decide in advance whether it's going to be member-managed or manager-managed. Most of them are member-managed because then the managers can't bind the owners contractually. That's an important point, if you're going to check that box. And then secondly, make sure that you actually respect the entity, do the documentation, document how money's going in. Now, silent partners. This term always excites me. Silent partners. We have some silent partners. Now, if you go look in Webster and look under partner, you'll see one of the definitions is a person with a voice in the affairs of the business. Well, that's an oxymoron then, a silent partner. My experience in business has been there's no such animal as a silent partner. Every partner certainly has a voice. Every stakeholder has a say-so. Accordingly, you want to figure out a way out for them. If you choose to use other people's money in the form of invested capital, and you're going to use a limited liability company, they're going to be a lender, then let's document the repayment schedule. If they're going to be an equity holder, then let's document it with evidence in the form of securities. Let's actually have member certificate interests. Here's why. If you don't have a member certificate interest in the state of Wisconsin, then the ownership and the voting rights of the limited liability company are equal to the capital account dollars that exist at the time of voting. If you took in a 10% limited partner, in your mind a silent partner, and he put in $100,000 and you put in all the work, and your capital is $10,000 and his is $100,000, and you haven't documented properly with an operating agreement and membership certificates who actually owns the enterprise, then upon voting, he gets 100 votes and you get 10. That's the law. The capital account dollars are the amounts of the votes. So if he's going to have 10, issue him a member certificate for 10%, enter an operating agreement that recites precisely what his rights are or her rights are as a additional financing partner, and plan a way out. What's the redemption? What are the facts and circumstances that precipitate a redemption, and who can call it? If you want to be the one that calls when the redemption happens, then that should be in the operating agreement. If it's an LLC, the shareholder agreement, if it's going to be a corporation. So let's make sure we plan the way out. Document the relationships. Just sticking the money in will lead to trouble. Having separate LLCs is a great idea to isolate liability, but not if they don't have substance in accounting reality. They have to have bookkeeping substance, their own checking account and so forth. Now, the other thing is involved communication. What that means is, earlier we talked about the budgets, forecasts, and all that kind of thing. People who are stakeholders in your business, your wife, the bank, your silent partners, your operating partners, maybe key vendors, are all investors, stakeholders, if not legally, if not in financial, documented reality. Plan on involved communication. Involved communication is the way to keep bankers, spouses, partners, key vendors, suppliers, and other investors happy, or at least, if not happy, informed. What that means is give them my reports. That is to say, you give them reports, but they can look at them and go, oh, my, or they can read them at their volition. But the bottom line is you're planning on involved communication. Now, again, this sounds an awful lot like heard that, been there, done that, common sense. Many of you have hair the color of mine and know what I'm talking about, but we just don't do it. We just don't do it. Now, As for periodic communications, the operating agreement often is silent about routine meetings. Shareholder agreements are often silent about routine meetings. I strongly advocate for our clients that they have somewhat structured, periodic, planned in advance, targeted to get to meetings, even if it's only, let's go to dinner, let's bring the wives or not, or husbands or not, all right? But let's have these meetings, and let's have an agenda, let's actually have documents, and let's go through them point by point. Quarterly is a good idea. Involved communications. Okay.